Hi guys, welcome back to my channel Ask Parul, and Ask stands for Always Seek Knowledge. And in this channel I focus on sharing my knowledge on getting professional growth, helping people gain financial security and personal development to help and inspire people to live a well-rounded, balanced and successful life. So if any of these three topics resonate with you, then do subscribe to my channel. Look into the playlist of my channel for other useful videos. I've linked the three playlists in my description link so that you can go and check that out. So, welcome back to this investment series. We are in episode number three right now. I hope you have looked at episode number one and episode number two. So, in episode number one, we basically spoke about what is investing. We also spoke in brief about the two kind of investments, which is stocks and bonds. In episode number two, I spoke in detail about the pros and cons of stocks and bonds, compare them across four different parameters. If you have not checked that out, go and see that. I'm going to be linking that in my description box below. And if you are new to my channel, then do subscribe, do share it with other people as well who you feel can benefit from this analysis. And also look into the finance and investment section of my channel for other useful videos across investments and personal finance. So let's dive into this episode number three. Section number one is about what are mutual funds. Now, mutual fund is a kind of investment which pools money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. And this allows investors to gain a lot more exposure to a wide range of investments with a single purchase. Now, the biggest difference between mutual funds and stocks is that stocks are an investment in a single company, whereas mutual funds have many different kind of investments, which means that potentially hundreds of stocks can be bought in a single fund. So it offers a lot more diversification of assets when compared to stocks. So section number two, we are going to talk about that why we should be investing in mutual funds. Now, one of the key benefits that mutual funds offer is the diversification. And this is one of the most important principles of investing. So, unlike the stocks where you are investing in purchasing shares of a single company, mutual funds are a lot more diverse. So, let's assume if a single company fails and all your money was invested in that one company, then you have lost your money. However, if a single company within a mutual fund fails, your loss is much more constrained. And mutual funds offer and provide access to a diversified investment without the difficulties of having to purchase and monitor dozens of assets yourself. So, mutual funds are a relatively hands off way when compared to stocks to invest in many different assets at once. So, if you purchase, let's say, one single mutual fund, you can gain exposure to hundreds of stocks, bonds, and other kind of investments as well. So, the next section that we're going to talk about is what are the different kinds and different types of mutual funds. Now, there are a few different kind of mutual funds. So, for example, the equity funds are a lot more focused and have a higher proportion of investments in equity or stocks, and hence they carry a larger risk and a higher risk, but it comes with a higher return. On the other side, we have the debt funds, which are a lot more focused on corporate or government bonds, and they usually carry less return, and with that comes less risk as well. If you don't understand what are stocks and bonds, please do check out episode number two, where I've spoken about and compared stock versus bonds. And then the third category is the balanced funds, or sometimes also known as hybrid funds, which invest in a mix of stocks, bonds, and other securities as well. So, the next section that we're going to talk about, which is very, very important, is actively managed mutual funds and passively managed mutual funds. So, a mutual fund's fees and performance will largely depend on whether it's actively managed fund or it is a passively managed fund. So let's quickly take a look at these two kind of funds as well. So if you are invested in an actively managed funds, it will generally have a professional manager or a management team making decisions on your behalf about how to invest the fund's money. They'll often try to outperform the market or a benchmark index for delivering more return, but that usually comes with a higher management fee, something that we call as an expense ratio. And that's why if you combine different overhead expenses and fees and management fees, even though the actively managed funds might give slightly higher return, but if you factor in all the different kind of fees on top of it, they may turn out to be slightly more expensive than the passively managed funds. So what are passively managed funds? Now, The passively managed funds will try to invest to align with a specific benchmark. They try to match the performance of a market index such as the S&P 500, and therefore typically don't require management by a professional or an active fund manager, which translates into a slightly lower fees and slightly lower overhead expenses for the fund. And in the long run, it could mean that passively mutual funds often carry lower fees when compared to actively managed funds. Now, we are going to take a look at a quick glance about these actively versus passive managed mutual funds in just a minute. All right, so let's take a look at a quick glance to compare these two funds. So let's just compare these actively managed funds to the passively managed mutual funds, and we'll compare them across four different parameters. So parameter number one is the investment objective. So like I was telling previously as well, that the actively managed mutual fund will try to beat the investment returns of a related benchmark index. The passively managed mutual funds, on the other hand, will try to match the investment returns of a related benchmark index. It could be an S&P 500, for example. In terms of the instruments that they both invest in, it's generally the same. So both of these mutual funds will try to invest in stocks, bonds, and other securities. In terms of the management style, the active managed funds will generally have a fund manager or an analyst who would be choosing the fund holdings. The passively managed mutual funds, on the other hand, is automated to match the exact holdings of a benchmark index. And in terms of the average management fee, something we call as an expense ratio, the active managed mutual funds tend to have a higher fees when compared to the passively managed mutual funds. All right, so I hope that was helpful and it helped you to get a better understanding of what are actively managed mutual funds and the passively managed mutual funds. So the next section that we are going to talk about is that how do mutual funds profit work? So your investment in a mutual fund can increase in three different ways. Number one is through the dividend payments. Now, when a fund receives dividend or interest from the securities in its portfolio, it distributes a proportional amount of that income to its investors. And when purchasing shares in a mutual fund or an ETF, which we'll talk in the upcoming episodes as well, you can choose to receive your distributions either directly or have them reinvested in the fund. And if you are just wondering what is dividend and distribution, I've made a separate video. I'll link that in my description box below, or you can look into the playlist of my channel comparing dividends with distribution. So that's the number one way, either through a dividend or a distribution, that the mutual fund profits work. Number two is the capital gains. Now, when a fund sells a security that has gone up in price, that's when it's called a capital gain. And when a fund sells a security that has gone down in price, that's essentially called as a capital loss. The third way is something we call as NAV, which is net asset value. So a mutual fund share purchases are final after the close of market, when the total financial worth of the underlying assets is valued. The price per mutual fund is known as its net asset value or NAV. So as the value of the fund increases, so does the price to purchase shares in the fund, or the NAV per share goes up. This is similar to when the price of a stock increases. You don't receive immediate distributions as such, but the value of your investment is far greater if the NAV increases, and you would make money or profit should you decide to sell your shares or mutual funds. So that brings us to the end of this episode number three. Just to conclude, I would like to say that keep in mind that mutual funds are not 100% hands off. You still have to be on top of your portfolio. You may want to rebalance it periodically, check the fees that you are giving, ensure that you are still invested at an appropriate level as per your risk, your personal circumstances, and to ensure that your investments is generating return that you desire. If you have a fund manager or a broker, ensure that you talk to them regularly, at least on a 6 monthly basis, to see if the kind of investments that you have put in, it does suit your requirement as well. And another option which I would like to just touch upon is that you might want to explore something which is called as a robo advisor. And a robo advisor is an online portfolio management service that invests for its clients and automatically rebalances portfolio as needed. There are a lot of companies that generally invest in ETFs through robo advisor. I will give the link in my description box below so that you can go and check that out. What is robo advisors? What do they do? And that brings us to episode number 3, where we did a deep dive on mutual funds. We looked at different kind of mutual funds, actively managed mutual funds, passively managed mutual funds, how they work, how they generate profit. We looked at the concept of diversification as well. And in my next episode, which will be the final episode of this investment series, we will be comparing two different kind of passive mutual funds. We'll compare index funds with ETFs, which is exchange traded funds. And with that, we will conclude the investment series. I hope you have liked this series. If you do like the content of my channel, give it a thumbs up. Do subscribe to my channel if you're new to it. Look at the playlist of my channel for other useful videos as well. Do share it with other people as well. Like, comment, and subscribe. Goodbye.